This specialization is aimed at any investor who follows a particular asset class but wants to learn more about how other markets work. You might be an energy futures trader, for example, who fully understands the fundamentals of affecting the price of crude oil and natural gas, but you know very little about how energy companies operate. Or you might be a great equity trader, but have little idea about what the driving forces are behind the corporate bond market. Since this course is intended for you to learn how capital flows around the world and how these markets are linked by various asset classes, we're going to take you on a journey. Our first stop will cover equity fundamentals, including an in-depth look at corporate accounts, as well as how the business cycle affects companies and how investors might navigate changes in the economic cycle. Our second trip will take you trading around the world, where we'll introduce you to foreign currency exchange, why the market exists, and what you should consider when trading in a currency other than your own. Next, we'll explore corporate and municipal bonds, including who participates in these markets and why, as well as the impact on the value of these financial instruments from interest rate changes and shifts in central bank policies and actions. On the final leg of our tour, we'll introduce you to the options and futures market to help you understand their function, why they are needed, and various strategies you may employ. By the end of this specialization, you should have a solid grounding in global trading and capital flows. You may want to note that as many of our lessons refer to IBKR's Trader Workstation trading platform, you might consider opening a simulated account at no cost or obligation. The platform is intended for you to put to the test any of the practical demonstrations included in the courses. To access it, refer to the accompanying course notes. And should you apply for a paper trading account, you will also have access to any of the news, research, delayed market data, and free tools available to all clients. Lastly, to facilitate a comprehensive understanding of essential concepts discussed, this specialization includes a series of practical examples, quizzes, reading materials, and other assignments. I'm Stephen Levine with Interactive Brokers, looking forward to your participation. Ever wonder about the role of the stock market, where an exchange or portfolio is, how capital is utilized, what risks you might face as an investor? What is the business economic cycle, and what is the difference between fundamental and technical analysis? These definitions and starting concepts are just a few of the topics that can help novice investors better understand what capital markets and investments are about. In this course, we'll look at industries and economic sectors that neatly define an economy. We'll also introduce you to fundamental concepts involved in a company's annual statements, such as balance sheets, cash flows, and its income statement. We'll also explore popular fundamental values used to filter vast amounts of corporate stocks. And finally, we'll examine mutual funds and ETFs as alternatives to individual stocks for investing. We thank you for joining this course, and we encourage you to participate in the reading materials and assessments.
What is the stock market for? The role of the stock market is to provide a venue for investors to buy and sell individual company shares, funds, or other financial products. The stock market enables those interactions using the mechanism of price discovery based on fundamental and technical analysis. Changes in share prices allow investors to buy or sell financial products they are interested in owning. What is an exchange? Stock market exchanges are private businesses that facilitate financial transactions during all or part of the day. Nowadays, most exchanges are fully electronic and receive inbound orders from broker-dealers whose clients want to buy and sell shares. An exchange has members and rules about who and how transactions may be made. Upon completion of a transaction, outbound confirmations are sent to broker-dealers for their clients. Depending on the broker, investors may choose which exchange venue to send their buy and sell orders to. Each exchange has a certain model of operation that is used to communicate with the brokers. Collectively, exchanges make up the broader stock market. What is capital? Capital can come in many forms and is typically associated with asset classes such as cash, real estate, property, stocks, bonds, silver or gold. You may hear people talk about intellectual property as capital, along with human capital or even antiques. All of these are a store of value in one form or another and can be considered forms of capital. Bringing together different forms of capital typically enables investors to grow their capital. For example, forming a company, using capital to acquire raw materials and pay laborers to build a physical product, which can be sold for a profit. Or it could mean investing an amount of capital into another asset class with the expectation of watching its value increase. Often, without capital investments, even the best ideas cannot be translated into being successful. One way business owners raise capital is by selling off a portion of a company to the public at an agreed upon price in exchange for ownership in the company. What is an investor? An investor is someone who puts capital to work in an asset class. If we are describing stock market investors, there are several types, but usually such investors buy and sell shares in companies with a few goals in mind. Investors generally intend to buy something in order to sell it at a higher price. Or they invest to receive a yield. An example of yield can be in the form of a dividend, which is a flow of cash payments made by the company paid out to investors. What types of investors are there? Some people invest for a living, so they use existing capital to buy and sell with the goals of making enough money to earn a living or operate a financial services business. Other investors might act far less frequently and invest for a longer period in a company whose product they are familiar with. Members of the workforce often contribute some of their salary to an investment plan, such as an IRA or 401k. Contributions can be directed to a designed company who manages various retirement plans. Often represented by the members of the workforce, major pension funds or asset managers consist of a share of participants operating within the stock market. Other asset managers, such as hedge funds or advisory services, may act to invest on behalf of capital contributors who don't have time or the specific knowledge to make investment decisions. Analysts working on behalf of investment companies spend countless hours trying to find well-run companies to invest clients' money into. What is equilibrium? When two opposing forces are equal, a state of equilibrium exists. And so, when buyers and sellers are content to exchange shares at the prevailing market-determined level, prices are said to be in equilibrium. If, over time, there are more buyers than sellers, buyers tend to bid up prices to tempt fresh sellers until equilibrium is restored. Individual share prices may also respond to the overall direction of the stock market. If stock prices correct to the downside by 20%, individual share prices may be dragged down in response to a broad market sell-off. What is risk? When it comes to investing, risk can be broadly defined as the probability of increasing or decreasing capital. Every investment opportunity carries the inherent chance of improving or worsening the value of the initial capital sum. The implied chance of a profit or loss defines the investment risk. Investments in some companies are said to be riskier than in others. That could be due to how well established the company is, how it is managed, how well it can access debt in order to expand or survive, or it could be the success of its products or how nimble it is in the face of changes in demand for its products. What is diversification? If two investors hold the shares in the same company, an investor holding this single stock may be risking more than an investor holding two stocks. If the loan company becomes insolvent, the first investor loses everything. For the second investor, the loss would represent just half of his entire holdings. A variety of holdings found in a portfolio may allow the investor to achieve greater diversification. What is an index? Reporting on the performance of stock markets often uses a benchmark to describe its activity. Common benchmarks are referred to as an index that enables investors to view the performance of the broad market against their own holdings. If the stock being held by an investor rises by 2%, while the market index rises by 1%, the investor has outperformed the broad market. Common benchmarks include the S&P 500 index and the Nasdaq Composite Index. When comparing performance, investors should be aware of the composition of what they are holding and consider an appropriate benchmark index to compare against. What is a portfolio? A portfolio is the collection of investments that one owns. One way to diversify against risk is for a portfolio to be spread out across a variety of factors. These factors may include asset class, company size, sector, industry, geographical location, yield, valuation, or many more. Diversification is one way to help investors considerably reduce risk. Conclusion. These definitions and starting concepts are just a few pointers that can help novice investors better understand what capital markets and investments are about. In later lessons, we will look at industries and economic sectors that neatly define an economy. We will also introduce you to fundamental concepts involved in a company's annual statements, such as balance sheets, cash flows, and its income statement. The aim for many investors is to grow their portfolios in line or above a major stock market benchmark index. Market timers will aim to join in the upside of the stock market and avoid as much of the downside as they can. Others will attempt to outperform the broad market index by superior stock selection. That means by owning stocks that do better than average when the market goes up and avoiding those that underperform. However, there is another investing angle that is often considered in the investing process. Savvy investors attempt to invest according to the business or economic cycle. It is thought that certain companies do better than others at certain times of the economic cycle. This image shows the 6 stages of a business cycle. While the steps of a cycle might look easily defined on paper, economists and analysts often disagree about exactly where we are at any moment in time. It is hard to say how long any stage of the cycle will last, making this style of investing that much harder. A very simple example could be investing in banks when interest rates are rising. Why? Well, when the economy is expanding rapidly, the central bank moves to head off potential inflation by increasing interest rates or raising the cost of borrowing, under the assumption that vigorous growth will likely continue. As the yield curve moves higher and the relative price of loans increases relative to the cost to borrow in the short term, banks are well positioned to grow earnings. Given this context, investors tend to favor banks and other companies in the financial sector when economic growth is taking off. In this chart, you can see sectors that may lead the pack relative to one's view of the current economic cycle. One of the major tasks here is to identify precisely where we are within the economic cycle in order to outperform a benchmark. And on the flip side, there are what are known as defensive stocks or safe haven assets that tend to hold up well in times of crisis. For example, utilities companies are known for paying out high dividends to shareholders. Shares in such companies tend to do well when market rates of interest fall in anticipation of central banks' monetary policy reductions as the economy exhibits signs of slowing. Investors are said to reach for yield in the face of monetary policy easing. Let's look again at the business cycle and walk through the different stages. Economic growth resumes following a period of low growth or even contraction. Expansion could occur following government stimulus, through lower taxes or a boost in spending in response to a period of slow growth. When growth slows, the central bank typically reduces the cost of borrowing to reduce borrowers' interest payments, encouraging businesses and consumers to borrow. In response to such economic stimulus, employers begin to take on more labor as business development initiatives are created. The rising level of employment creates additional business and consumer confidence and spending, and increased activity in the housing market. Economic growth turns positive. While it can be easy to spot a period of sustained weak growth in advance of stimulus, it can be more difficult to identify precisely when the expansion has run its course. More often than not, the economy advances with ebbs and flows. Several economic indicators might expand in the same direction for a good length of time before some begin to falter temporarily before resuming their advance. The actual peak in activity is often spotted in the rearview mirror. Expansions can last for several years. Growth in the labour market leads to a marked reduction in the unemployment rate. All confidence measures are healthy, and the stock market tends to continue discounting a positive outlook. Frequently, there is not a single reason behind the high watermark for economic growth, and the peak level of output can be attributed to a variety of factors, including external demand. During an expansion, the central bank typically attempts to raise the cost of borrowing in response to healthy employment growth and keeps abreast for signs of building price pressures in the pipeline. The natural increase in interest rates may even be a contributing factor to the peak in the economic cycle. Inadvertently, the central bank may have attempted to protect against a build-up of inflationary forces too hard or too long, taking away the legs of the expansion. However the tipping point is reached, the pace of hiring typically starts to wane. Various measures of consumer and business confidence edge lower, and businesses pare production in response to rising levels of inventories, indicating slowing demand. Typically, the yield curve begins to discount a period of monetary easing at the central bank as a required response to protect from the slowing economy. A recession is officially defined as 2 consecutive quarters of back-to-back declines in gross domestic product or GDP. Sometimes the slowing economy remedies itself after a period of such slower growth before the expansion resumes. In more protracted downturns, the economy falls into depression. A significant and protracted period of economic malaise is called a depression. These don't happen often, but when they do, it seems like no amount of policy stimulus can help budge consumers and business out of their malaise. Weak confidence feeds on itself. Consumers won't borrow nor spend because they are pessimistic about the outlook. Because consumers are mired in woe, businesses fail to take advantage of cheap loans because they can't see a time when demand will start to pick up again. Often, businesses end up sitting on bulging inventories and pare back production because they can't sell what they've already produced. They lay off more and more employees, the rate of unemployment soars, and confidence falters. Just like it might be difficult to label the peak in economic activity, the trough in output or the business cycle is often spotted in that rearview mirror. Businesses stop shedding workers and find that, in order to meet current demand, they are forced to hire. Increased hiring leads to improvements in confidence and greater spending. And as the months go by, the economy is once again in expansion mode. The business cycle is a difficult beast to identify and to understand. It might be easy to state that the economy is expanding, but it could be difficult to determine whether the peak to the cycle is behind or still ahead. Yet the business cycle is important because investors attempt to concentrate their investments that are expected to do well at certain times of the cycle. One very simple example is the behavior of 2 different types of consumer-oriented stocks throughout the business cycle. Imagine we can define consumer staples and consumer discretionary stocks as food and automobiles. Consumers pretty much buy the same amount of food in good times and bad times. On the other hand, consumers only trade in or trade up their car purchases when they are not only employed but optimistic about the safety of their jobs and confident that they could get a promotion or a higher paid job with another employer. Consumer staples tend to outperform when the stock market is not doing so well or when the business cycle is past its peak or even signaling recession. Discretionary consumer stocks tend to outperform when investors sense the economy is expanding and the outlook for employment is improving. Here is a chart of the broad S&P 500 index. Here is a chart of the consumer staples sector. Can you tell which is better performing? This chart really gets to the point about why investors care about economic growth and where we are heading over the next 12 to 24 months in terms of the business cycle. To dig deeper, we need to look at how the economy can be broken down into logical and meaningful sectors. Breaking down the US economy into logical pieces is no easy task. To help with that process, government agencies helped create the North American Industry Classification System, or NAICS for short. This helps to establish companies into sectors with broadly similar characteristics. Let's take a tour of SPDR Select Sector's investing definition of each economic sector along with the associated industry breakdown. Consumer Staples invests in companies that are primarily involved in the development and production of consumer products that cover food and drug retailing, beverages, food products, tobacco, household products, and personal products. There are 33 companies in the Consumer Staples Select Sector SPDR. Consumer staples has two equally weighted industries accounting for about half of the sector: beverages and household products. Other large components are foods and staples retailing and food products. Tobacco and personal products make up the rest of the consumer staples sector. Healthcare consists of companies whose primary business may include healthcare equipment and supplies, healthcare services, biotechnology, and pharmaceuticals. There are 62 companies in the healthcare select sector SPIDA. Around 1/3 of the sector is made up of pharmaceutical companies, while 1/4 is comprised of healthcare equipment and supplies. Further down the channel comes healthcare providers and services, followed by biotechnology, life sciences, tools and services, and finally healthcare technology. Real estate is composed of companies primarily involved in the following industries: real estate management and development and REITs, excluding mortgage REITs. There are 32 companies in the real estate select sector SPIDA. Real estate investment trusts, or REITs, form almost 98% of this sector, with management and development companies topping up the balance. Communications is composed of companies primarily involved in modern communication activities and information delivery. Industries include telecommunications, media, wireless, entertainment, and internet media. There are 26 companies in the Communications Services Select Sector SPIDA. Communications may be broken down into interactive media and services, media, entertainment, and diversified telecom services. Energy invests in companies that primarily develop and produce crude oil and natural gas and provide drilling and other energy-related services. There are 29 companies in the Energy Select Sector SPIDA. The energy sector is broken into oil, gas and consumable fuels, and energy equipment services. Industrials invests in a wide array of industrial companies. Industries in this SPIDA include aerospace and defense, building products, construction and engineering, electrical equipment, conglomerates, machinery, commercial services, and supplies. There are 69 companies in the Industrial Select Sector SPIDA. Here, the list of industries within the industrial sector is lengthy, with the heavyweights of aerospace and defense, machinery, and industrial conglomerates forming more than 60% of the sector. The smallest component is construction and engineering, where members account for less than 1% of the sector. Technology is composed of companies primarily involved in such industries as software and services, IT consulting services, semiconductor equipment, computer, and peripherals. There are 68 companies in the Technology Select Sector SPIDA. Here, 6 industries comprise the sector, including software, IT services, semiconductor and semiconductor equipment, technology hardware, and storage and peripherals. Consumer discretionary invests in industries such as automobiles and components, consumer durables, apparel, hotels, restaurant, leisure, and retailing. There are 63 companies in the Consumer Discretionary Select Sector SPIDA. The largest industries represented here are internet and marketing retail, specialty retail and hotels, restaurants, and leisure. Financials invests in a wide array of financial service firms with diversified business lines ranging from investment management to commercial and investment banking. There are 67 companies in the Financial Select Sector SPIDA. Banks, capital markets, and insurance industries represent more than 80% of this sector. Materials is composed of companies primarily involved in such industries as chemicals, construction materials, containers and packaging, metals and mining, and paper and forest products. There are 28 companies in the Materials Select Sector SPIDA. The chemicals industry is the major heavyweight in the sector. Containers and packing is the next major industry. Utilities invests primarily in companies that produce, generate, transmit, or distribute electricity or natural gas. There are 28 companies in the Utilities Select Sector SPIDA. Electric utilities form the major industrial group within utilities, while multi-utilities is only half its weighting. Water, independence, and gas utilities are very small in comparison. In this lesson, we will explain what mutual funds are, discussing the different types of mutual funds, and explore the potential benefits and considerations of investing in this type of investment product. For starters, a mutual fund is an investment that combines your money with money from other investors. The combined pool of money is used to buy shares in various securities such as stocks and bonds. These securities make up the fund's portfolio. The combined money is professionally managed by the fund's portfolio manager. Every shareholder may gain profits and incur losses in equal portion. Each share in the mutual fund represents an investor's part ownership in the fund. Mutual funds come in many flavours. Let's cover the choices. Equity funds invest in stocks. When you own a stock, you own part of a company. Fixed income funds buy investments that pay a fixed rate of return, such as municipal bonds, mortgage-backed bonds, and corporate bonds. Money market funds invest in short-term fixed income securities, such as treasury bills, certificates of deposit, bankers' acceptances, and commercial paper. Balanced funds invest in a mix of equity and fixed income securities. Index funds aim to track the performance of a specific index, such as the S&P 500. And specialty funds can focus on sectors such as real estate, technology, or healthcare, or they can have a specific mission, such as socially responsible investing. Fund of funds, like the name implies, are mutual funds that invest in other funds. Now, let's explain active versus passive management. With an actively managed mutual fund, the portfolio manager buys and sells securities and attempts to outperform the return of the overall market or other benchmarks. A benchmark is a standard against which the performance of a security, mutual fund, or investment manager can be measured. Passive management involves buying a portfolio of securities designed to track the performance of a benchmark's index. The mutual fund's holdings are only adjusted if there is an adjustment in the components of the index. There are two categories of mutual funds: open-end funds and closed-end funds. Open-end funds have an unlimited number of shares and are priced at the end of each trading day. Closed-end funds have a set number of shares whose price may fluctuate throughout the trading day. To invest in a closed-end fund, there must be shares available and you must buy an existing share. These funds trade like equities. One of the biggest benefits of investing in mutual funds is that investors will get broader diversification, as one fund share may contain dozens of underlying stocks, bonds, or a combination of both stocks and bonds. A mutual fund is generally overseen by a portfolio manager who has expertise in investment selection. Portfolio managers may also have research teams to assist them. Another perk is that you don't have to pick securities and manage your own investments. And you can often start investing in mutual funds with a very small initial investment. Before investing in mutual funds, consider if they are an appropriate investment for you. It's important to consider what your goals are. For example, are you investing to pay for college, buy a home, fund your retirement, or another large future expense? You should also consider your time horizon. Think whether the fund is likely to achieve your goals within your time frame. Also think about your personal risk tolerance. Consider which fund has the appropriate risk level for you. And consider the tax impact. Think about what the tax impacts of the fund's yield may be. Or consult a tax advisor to help you determine the tax impact. And remember, all investments are risky and that you can lose your principal. In this lesson, we will cover how to buy and sell mutual funds, how the price of a mutual fund is determined, and explain various types of trading fees. You can invest in mutual funds in a variety of ways. In the US, many people invest through a retirement plan, such as a 401k plan or an individual retirement account. Mutual funds can be bought through a brokerage account, through the fund directly, or through many banks. You can enter an order to buy or sell a mutual fund any time the New York Stock Exchange is open. Trades in mutual funds are priced at the end of the day. They are priced once daily after the stock market closes. Mutual funds shares are created only at the end of the day due to the way their prices are determined. After the market closes, the mutual fund company calculates the net asset value, which is also called the NAV, of each fund they offer. The net asset value is based on the value of all the assets, meaning the cash plus the securities, in each mutual fund, minus any liabilities, divided by the number of outstanding shares. Here's an example. ABC Mutual Fund has $50 million in assets and $10 million in liabilities, and so its total value is $40 million. This fund has 4 million shares outstanding. Dividing the fund's $40 million in assets by the 4 million shares outstanding provides the price per share of $10. The costs and fees of different types of mutual funds vary broadly, and there are several different ways fees may be incurred. Investors are always encouraged to read each fund's prospectus very carefully and consult with their professional advisor to determine which funds are most appropriate for their specific needs. Here are some of the more common types of mutual fund fees. When investing in Class A shares, there is typically a purchase fee or front-end load, which means you'll pay a percentage of your purchase amount every time you buy shares. However, purchases made by a professional advisor may be exempt from those fees. Front-end loads typically range between 3% and 5%, but can be higher. Here's an example of a front-end load. If you buy $10,000 worth of shares of an A-share mutual fund that has a 5% front-end load, you will pay a $500 fee to purchase those shares, which will come out of your total investment. That means that your investment in this fund will be $9,500 instead of $10,000. When you purchase Class C shares, there is typically a fee called a back-end load. This fee is also referred to as a Contingent Deferred Sales Charge, or CDSC. Here, you don't pay any fees when you buy shares, but when you sell shares prior to a time period specified in the fund's prospectus, you will pay a percentage of the dollar value of your redemption based on the number of years that you held your fund position. The period is typically 1 to 3 years. If you hold the shares until after the period specified, you won't have to pay the back-end load. If you bought shares in your fund on different days, most funds will calculate your CDSC fee using the first-in, first-out method. That means the first shares purchased will be the first one sold. Funds that want to discourage short-term trading, which is often disadvantage to the fund's investors, impose short-term redemption fees. These are often referred to by their acronym, which is STR fees. This fee is typically imposed for redemptions occurring within 7 days to 6 months of the original purchase. Do-it-yourself investors can avoid paying sales charges by purchasing no-load funds, or avoid transaction charges by purchasing no-transaction fee mutual funds. With a no-load fund, no fee is directly charged by the fund when shares are purchased or redeemed, although sometimes the investor's broker or advisor may charge a transaction fee. There are also no transaction fee funds, or NTFs. That means there are no fees charged by the broker or advisor for each of the investor's trades. But keep in mind, there can be front-end loads, STRs, or back-end load fees charged by the fund for each purchase or redemption. 12b-1 fees may be charged by your investment professional, as compensation for the expenses they incur in marketing and servicing your fund. Finally, all funds charge a management fee, and that fee reduces the fund's overall earnings. The management fee must be disclosed in each fund's prospectus.
The aim of this course on equity fundamentals was to show you how to practically invest in equity assets. First, we covered some of the basics of the stock market, who the participants are, what equilibrium is, diversification, and what an index is. These concepts are just a few of the pointers to assist you in better understanding what the capital markets and investments are about. The business cycle is a difficult beast to identify and to understand. It might be easy to state, for example, that the economy is expanding, but it could be difficult to determine whether the peak of the cycle is behind or still ahead. Some savvy investors attempt to invest according to the cycle. So we explained the 6 stages of a business cycle, and as an example, how the behavior of 2 different types of consumer-oriented stocks may perform. To dig deeper, we needed to look at how the economy may be broken down into logical and meaningful sectors. We explored different benchmarks, such as beta, as most assets are compared to the standard benchmark specifically to explain whether an asset is underperforming or outperforming. We also explored the popular sector SPDR ETF to view different industry breakdowns, such as consumer staples, healthcare, communications, and more. Since investors and analysts might spend hours crawling through a company's quarterly and annual statements searching for clues about how well the firm is doing, this course examined several commonly reported items on most firms' balance sheets and conveyed the relative importance of such concepts to investors. We thank you for joining this course, and we encourage you to participate in the reading materials and assessments.